conscious I'm the only member of the panel here that is sat in London and not sat in Iberia. And unsurprisingly, with the lockdown, it has been a few months since I've been in Spain and Portugal. It was in February, but thankfully we do have a very good team based out of Madrid, led by Daniel Galvez. And I think importantly, we are still active in the Iberian market. We have a number of ongoing deals in multiple locations and multiple sectors over in the market. I think my overriding sort of message from this sort of short presentation that I'm going to give about our outlook for the Iberian market is one of cautious optimism. I think in terms of the optimism, we had a number of points from Maria Jesus there, which we fully agree with. One, that this is an event-driven recession. This is not the financial crisis. We're seeing the easing of lockdown. We've seen the rallying of global equity markets and global debt markets, and certainly the interventions from government and central banks have been unprecedented. You know, compare this to the financial crisis. Government, central banks, they've moved far further and far more quickly than anything we were seeing in 2008 and 2009. I think from a real estate perspective, though, this is the important part. Fundamentals today are far better than what we are seeing in the financial crisis. So I think the Iberian market is a great example of this. If we look at the level of oversupply and overbuild that was going on in Iberia ahead of and going into the financial crisis, it is starkly different today. Yes, there's been a pickup in development over recent years in Iberia, but nothing compared to what we were seeing in 2008, 2009. So we don't expect a huge increase in vacancy that we were seeing in the financial crisis. So I think that's the area of optimism for us. But it is important today that we remain cautious. I think we have to accept that this crisis is not over. It sometimes feels like things are getting much better, and in many ways they are, but we've got to look globally as well. The likes of Spain and Portugal, these are open international economies, and when you look at, say, the rapid increase in cases of CV-19 in places like South America, for example, and the ongoing levels of infections in say North America and others, then this will continue to have a bearing upon economic activity. So I think our central case also is that we would expect a second wave of CV-19 in any markets. We wouldn't expect as severe a lockdown, and we wouldn't expect as much disruption as we've seen over the past 3 months, but nonetheless, we should still remain cautious about the ongoing economic impact. And I think importantly as well, we do expect to see further further increases in unemployment. I think we've got to remember across the 5 largest economies in Europe, so that's the UK, France, Germany, Spain, and Italy. By the end of May, we still had 45 million people who were covered by some sort of furlough scheme. So as those schemes start to be unwound, there is a high probability that we will see more unemployment, and that will have an impact upon the real estate market. If we turn to my first slide, what you can see here is that these are our expectations for capital value decline. This is at a European level. So these are our latest forecasts for capital values in 2020, the change in 2020 by sector at the sort of European average level. And what you can see here, look, on average, we are expecting value decline this year. We are expecting a price correction. You know, it would be very unusual for us to go into what is one of the largest recessions on record without seeing any correction in pricing across the real estate markets. Importantly, though, we are seeing differences across sectors, and this is very much mirrored by what we're seeing in the Iberian market as well. We're expecting the residential and the logistics sectors to be holding up far better than the other parts of the market. Office, we are seeing some decline there, but in all cases, this is a combination of yield expansion plus some rental decline. And then shopping centers, we're seeing a 25% fall in values on average across Europe in 2020. I think what I would stress in all cases, but particularly in the with shopping centres and offices, where we're seeing value decline. This is not every single asset will see a 25% fall in value. Certainly, there are many different types of shopping centres, many different markets, and we do see quite a broad range of outcomes across different markets. If we turn now to the next slide, what this is giving us is a bit more information about our outlook for the Iberian market, and this is a longer term perspective, what we see over the next 5 years. And what this is showing is, look, yes, we do expect 2020 to see a sharp fall in capital values across most sectors, but we do expect to see a rebound in values as well. And I think there's a combination of factors. One, we would expect from the second half of this year, we would start to see economic growth returning to the market. As I mentioned, fundamentals are in far better shape than they were compared to previous crises. And I think importantly as well, on the capital side, we are expecting to see further yield compression over the coming years. So yes, some yield expansion this year, but with a combination of very high levels of dry powder, with a lot of central bank intervention, with the ever quoted lower for longer bond yield across many markets, we would expect to see further inflows into the real estate market. So a return to rental growth from about 2022, and then further yield compression, more than we were expecting pre-CV19. And what you can see here across the Iberian markets are, on average, we're expecting these markets to be at least as good as the European average, and in some cases, particularly around residential and parts of the logistics market and perhaps Lisbon offices as well, we're expecting returns to exceed the European average. This doesn't necessarily mean we're going to come to an overweight call on the Iberian market. We would expect a slightly higher risk-adjusted return from the Iberian markets to reflect a higher level of risk that we see in Iberian markets, particularly some of the smaller cities like Lisbon, where at times there are concerns around liquidity there. But maybe just finally, I'm going to quickly canter through what we see as our top picks for the Iberian markets. First off, we've got Spanish logistics. Actually, this would be Iberian logistics, really. What I think everyone likes logistics at the moment. You know, you saw from our forecast, we're expecting the logistics market to be one of our top performers going forward, and certainly the Spanish market and the Iberian market is no exception there as well. As we see the acceleration of e-commerce, as we see very low levels of vacancy across this market, we would expect logistics to be an outperformer. I think the one thing, though, that I would stress on logistics, it still is very important that we fully underwrite our tenants for any investment in the logistics market. We've got to remember plenty of logistics is well connected to the retail sector. If we have any concerns about retailers and the solvency of retailers, we should be looking very closely at our underwrite of our tenants. But nonetheless, Spanish logistics, one of our top Iberian logistics, one of our top picks for the Iberian market. If we flick now to the next slide, residential. Residential, we have a very strong call on the residential market. We've got to remember that for many pan-European global investors, residential actually today is still a very small part of our portfolios. If you look at, say, the MSCI's PEPFI index on their balanced fund, we're talking sort of a 1 or 2% of those funds is going into residential today. We expect residential to, across Europe, but particularly in Spain as well, to grow as a much larger part of the investable market. We're seeing growing demand in the big cities for rental space, and we're certainly seeing the performance over the last three months, which suggests that the quality of income that you get from residential is very supportive throughout the cycle. So we're expecting a large amount of institutional capital to be coming into this, the residential market. What in particular, what we like at the moment is what we call commuter residential. So this is sort of it's somewhere between suburban and edge of city centre residential locations. Why do we like these locations? It's a combination of affordability for residents. Still, we're looking for areas with great connectivity. But if we are concerned long term about, say, more increase in working from home, for example, then perhaps these larger units, more family-focused units will be more attractive going forward and have that ability to see additional rental growth. So certainly, for example, a good example here, the picture is Badalona, which is a city, a location sort of just adjacent to Barcelona itself. There we're seeing plenty of opportunities for outperformance of the wider residential market. And then last but not least, here we have new office locations, and this is perhaps a bit of a controversial one, because certainly there are many question marks over office space at the moment. But we're not as a house saying that we expect to see the death of the office market. We certainly see a disruption coming to the office market, and as a share of the investable universe, we would expect office to become a smaller part of the investable universe. But nonetheless, we still see plenty of opportunities. Office will remain one of the largest parts of the investable universe. What we mean by new office locations here, we've got the picture is the 22 At district in Barcelona. These are not your traditional CBD locations, but still within the center of the city. These are still well connected. These locations, they're still accessible, but they're affordable to occupiers. They tend to, in the 22 At, for example, you'll be seeing a rental level of around 20 to 22 euros per square meter, and you compare that to the CBD, which is getting closer to 30. You're certainly getting a discount in these locations, but it's more than just a discount. It's offering lifestyle as well. They tend to be more mixed use, these locations, and they also tend to have more modern stock as well. So if we are again expecting to see changes in demand and changing usage of office space, then the stock within these new office locations does tend to be more aligned with what we would expect for the future.